Okay, Joe, we're ready.
Okay, thanks, Brian. My name is Joe Terril, president of Terril and Company, private wealth managers in St. Louis, Missouri, with about $750 million of discretionary money under management. Brian, we'll do an update on world economies, markets. Why don't we maybe go in the conference room and we'll sit in there to finish a little easier?
Sounds good.
Okay. Thank you for joining us. Let's get right into a discussion of world economies. In our last tape, we mentioned that economies around the world are slowing. Don't believe they're going to go into a severe slowdown. We're not in the camp of believing that we're going to see a worldwide recession, but no question economies around the world are slowing. We'll discuss in a few moments what I think that means for investment markets. Last night, Japan's economic news confirmed that they are in recession. Probably a decent amount of that is responsible by the major sales tax increase they had and consequently a slowdown in domestic spending in Japan. China is moving along at a reasonable pace, 7.5%, and we will see if that doesn't continue. We certainly expect it to. Europe is struggling, but headed in the right direction, and in our opinion, slowly moving to the point where we might see some positive economic growth numbers out of Europe. The United States is probably the star economy around the world right now, growing at a nominal basis of somewhere around 5%, 3% plus with the inflation subtracted out. So we have not changed our mind in the last 30 days over world economies. The most important development that we need to talk about is the falling energy prices, where we think that's going to lead world economies, what we think that means for spending around the world, and perhaps how that relates to the United States economies. And then Brian will get into discussing what maybe all of it means for investments.
Okay, very good.
Brian, the two things that most of our viewers should know that I'd really like to get across to them is two very important components of the world economy. The first one being the price of energy. We've seen a fall in energy prices that has come about because of production figures. When you look around the world, particularly in the United States, at production figures, it's surprised everyone to the upside. We believe we are in a trend in the United States in particular and around the world where for the first time in perhaps 35 years we're going to see cheap energy prices, certainly on a relative basis versus where they've been, as it seems like they've gone up every year, or every 2 to 3 years energy prices has consistently gone up. Very convinced those days are over. Look for oil to go into the low $60 a barrel price, and this should have a dramatic effect on world economies. Before we talk about how and why, let me talk about the second component that we're also very opinionated about right now, and that being interest rates. We've gone through a 2-year period where interest rates threatened to go higher. There were reasons why it looked like interest rates would go higher, but that is not happening. Those that have seen our past videos know that we've talked over and over again about markets staying strong and in many cases moving higher because interest rates remain zero around the world and there's no place else for people to go with money. This trend is not going to change anytime soon. You do hear people talk about, well, rates will start going up in the United States next spring. If they do go up, it'll be very minimal, and interest rates, in our opinion, for the next 2 years are going to stay down around the world. So a combination of low energy prices and low interest rates should keep the world economy moving along, perhaps help Europe recover a little bit more, and should be very much a positive for world economies. And with that said, Brian, let's maybe switch now and we'll start talking about investment markets.
Okay.
Investment markets should stay strong in the United States and around the world for the time being. The overdriving theme to these markets is the fact that there is no place else for cash to go. Interest rates are zero. Longer term bonds around the world are in many cases less than 2% interest. In some countries, short-term interest rates are actually negative. In this environment, you'll continue to see money go to anything that offers fixed rate, reasonable rate of return, and you'll also see money continue to go into the equity markets. With that said, we're not of the belief that markets are going to show 10, 15, 20% gains anytime soon. They'll stay strong. We don't look for any type of 15% pullback, but markets are going to begin to face a few obstacles, and that really is as the energy economy or the share of the economy that is created by the energy world, that's going to slow down, and you could see investment markets become a little bit concerned as major energy companies begin to report projects being postponed and or even outright canceled. So this will work its way through. Those things will happen first, then you would see the advantage of worldwide consumer spending, worldwide business spending, being able to take advantage of the lower energy prices. So those two things, which is going to work first, which will happen first, we'll see. But that should keep the market strong, but yet no runaway gains because there's going to be a few obstacles there for the economy to overcome. The low interest rates is certainly going to continue to be a positive, but as it relates to our markets, we continue to be in the camp of watching the U.S. dollar and watching the value of the U.S. dollar. The dollar going up, which we think it will continue to do. Certainly it's in position to continue to go higher. That strong U.S. dollar at some point can hurt corporate profitability in the United States. And if that happens, that will be a headwind that our markets will have to overcome. So put those things together. We're constructively optimistic on investment markets. We believe we can see 3-4% higher prices maybe in the near future, but we do not see a runaway bull market, and on the other hand, we don't see what's going to create a major pullback either. because of these two components. Low energy prices and low interest rates is a good duo to have in your favor for the investment markets. But prices are at record highs, and it's going to be difficult for prices to go dramatically higher from here until we can get the full effect of the lower energy prices worked into the entire world economy. Thank you for joining us. We'll be back in about 30 days, hopefully right before the end of the year, with an update on our outlook. My name's Joe Terril, president of Terril and Company, private wealth managers in St. Louis, Missouri. And Brian, very much appreciate your help. Happy Thanksgiving to you, your family, and to our viewers. And we'll catch you towards the end of the year with our next update.